everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today we have back Sal Gilbertie, who is the founder of Teucrium Trading. Sal, thanks for coming back on the show. Good to see you again.
My pleasure. Good seeing you as well.
I know you've just launched a new ETF. It's an agricultural ETF. Why don't you tell us a little bit about it?
That's correct. It's called the Teucrium Agriculturals Fund. It's a fund of funds, so it actually buys equal weightings in our underlying single commodity agricultural exchange traded products. So people get an equal weighting of corn, soybeans, wheat, and sugar, the big four of the agricultural sector, basically.
Now, what's the advantage of having it structured that way as opposed to having it, a direct investment in those particular commodities?
Well, if one's able to invest directly in commodities, that's probably the way to go. But we provide exchange-traded products so that most investors, ordinary people, and even institutions that may not trade futures, that certainly might not participate in the commodities supply chain, but they need direct exposure or want direct exposure of commodities, we allow that to happen through an exchange-traded product on the New York Stock Exchange, and that's really a simple mechanism that people understand. As far as agriculturals go, Teucrium's products all are designed to mitigate contango and backwardation.
Right, that's one of the unique aspects of your funds, right?
It is indeed. And so, we only focus on the agricultural and energy sector. Those are the commodities we know. We focus on where our expertise happens to lie. And that allows us to structure what we feel is superior product. We also, if someone wants to participate in corn, soybeans, sugar, or wheat, and they don't have a futures account, the only way to do it is through an exchange-traded product. Sugar does have a note out there, but we are exchange-traded products. We like transparency, liquidity, and ease of understanding, and of course the safety of not having credit exposure.
Right. Now, just to back up a little bit for people who might not know, on the Contango, the roll cost, just explain that some people might be novices at commodity investing, and the ETFs, some of them, your underlying commodity might rise in price, but you might end up not seeing that particular security go up because of the roll cost. Right?
That's right. And contango is when the price of futures rises going out. And futures contracts have a limited life, like an option, if you will. And so when a futures contract expires, the exchange-traded product that holds futures really needs to roll those, and to keep their exposure, they buy another contract. If that contract's higher priced, you kind of lose some exposure. So in a rising market, that can hurt you. Contango, the opposite of is backwardation.
Right.
Contango and backwardation don't always hurt you, nor do they always help you. The best thing for an investor to do who's going to trade long term, who's going to hold longer term, that's when contango and backwardation really affect one's portfolio, is to look for a product that's designed to mitigate those two things. If you have a short term time horizon, there's some excellent exchange traded products out there that just hold the front month and move very quickly with the commodity, and they're fine products. But if you're an asset allocator, if you want longer term exposure, if you rebalance annually or quarterly, you probably want something that mitigates contango.
Now, commodities have really gained popularity with institutional investors and also with individuals from the standpoint of diversification. I think investors are very familiar with equities, they're familiar with fixed income and bonds, but commodities now looked at as an asset class that is very useful in terms of diversification. When you look across the commodity spectrum, all right, are there certain commodities that offer better diversification? For example, we hear very often gold. People buy gold. Why? To diversify, and maybe hedge against a currency risk or whatever. But are some commodities better at diversification than others?
Well, I think in terms of what one might be looking for in correlation, lower correlation,
right.
Commodities all tend to correlate. So someone looking for a non-correlated asset, I think, needs to look elsewhere. But in the commodity sector, many people are familiar with gold and hold gold. It's a great question. Gold is a great portfolio diversifiers. They move more with the S&P 500 of late. Now, what most people don't know,
correlated?
Actually sugar. Sugar over 20 years correlates least of, if you do a study and looking at the 14 major commodities that trade in the exchange trade product mold, you can, medium. So you can buy an exchange traded single commodity in 14 different commodities. If you exclude gasoline, because it goes from leaded to unleaded, there's a lot of difference in the numbers there. But if you exclude gasoline, you have 13 commodities. And if you go back 20 years, they all correlate with the S&P 500. But the one that correlates the least is sugar. The sector that correlates the least are agriculturals. Then come precious metals. Most people think it's the other way around, but ags actually have less of a correlation in general than the precious metals.
I bet most people are not aware of that.
They are not aware of that. And in fact, industrial metals and energies have the highest correlation. They're all portfolio diversifiers, very effective portfolio diversifiers. But I think more and more attention will be paid to the agricultural sector, particularly when people find out that sugar correlates less than gold, and the R-squared factor. So a little bit technical, but the movements in the S&P 500 that cause an underlying movement in the commodity, that's measured by something called R-squared, and the lowest causal relationship is also found in sugar and the big four grains, if you will. Sugar.
I guess when things are looking really bad, people are eating a lot of that sweet stuff. I don't know, just to make them feel better,
well,
right?
It's true, and there's a couple things. I think that why one of the reasons Teucrium focuses where it does on the energy and agricultural sector is the last thing people will do in any circumstance is allow themselves or their animals to go hungry or cold. And so those are the last commodities people are going to stop using. There's relatively inelastic demand, relatively, in grains than other commodities. Your industrial metals and your energies are very cyclical with the economy. Grains are less so. So that's very important, and that, again, is a good reason to diversify your portfolio,
and it's also
perhaps.
A point that's always, made me question the whole gold thesis, as a protection against chaos and Armageddon. I mean, you can't eat gold. As you said, you're going to need to feed yourself, and you're going to need to have energy or heat. So those things make sense to me. Well, I don't know. You often hear it in the gold argument, but it never really made much sense.
Well, I heard Warren Buffett say on CNBC in an interview this spring.
He doesn't like gold.
Right. He said he would trade all the gold in the world for a number of Exxon Mobils and all of the farmland in America. And I think that speaks to the agricultural and energy sector.
Now, you got involved in this not too long ago. Your funds have been very successful. You've seen good growth and interest in your fund and money under management.
That's correct, yes.
But now we're seeing somewhat of a correction in the commodity markets. Is this of a concern to you? Do you think it's just a normal correction and the price trend, the upward price trend, broadly speaking, continues after this? Or is this going to be a longer, more important pullback?
Easy answer is I don't know. We don't predict prices. Our products go up with the commodity and down with the commodity. So they simply track the directional price movement of each commodity. So we give investors a way to participate, whatever their opinion might be. I think that in any contraction, everything is cyclical, commodities especially so. People also need to realize that agricultural commodities are extremely cyclical because of harvest cycles, and no one can control those. That has to do with winter and summer and vernal equinox and summer solstice and all that stuff. So it's very important for investors to understand.
I bet a lot of investors don't. I mean, obviously outside the trade, the people who, the farmers, the people who actually use or process the commodity, they're aware of that. But I bet most investors don't realize that there's opportunity in those cycles.
I think you're probably right. Sugar, for instance, in May, right around the beginning of June, that's the peak of the Brazilian harvest. Brazil's the world's largest sugar producer. You tend to have we call the harvest cyclical low. Now, it doesn't always happen. This year it happens to be tracking quite well, and people, look at maybe allocating some of their portfolio into sugar at that time. It's a cyclical harvest low. That happens in the autumn with corn and wheat and soybeans to some extent. Wheat there's winter wheat and summer wheat. Soybeans are harvested also in the southern hemisphere. So you do have these cycles that if an investor's aware, they can more efficiently, if you will, layer these things into and out of their portfolios.
And you're seeing the same sort of investor behavior, I would call it bad investor behavior, as we see in stocks. When stocks sell off, people sell their stocks, and it's exactly the time when they should be adding to their stock holdings. And commodities now, as price trends have backed off, people are liquidating commodity positions, and it's probably a great time to be adding to those positions, right?
I think we see the institutions doing exactly what you're describing as the smart thing to do. They buy as things cycle lower, and they sell as things cycle higher. I think the retail traders probably do more what you're saying, and they sell at the lows and buy at the highs. But people who are, I think, speak to an advisor. That's what we would tell people. Speak to an advisor, remain calm, always get advice, and study your category. So if you're trading stocks, talk to a professional and really study up on it. If you're trading commodities, it is important to know your commodities. It is sometimes more beneficial to buy an agricultural commodity during harvest. So those are things that people should be aware of and alter their actions accordingly. But investment professionals are starting to cover this more and more.
Know your investment. That's good advice. And
Absolutely.
just quickly, the new contract is TAG, right?
Tags, right? TAGS on the New York Stock Exchange, and it gives people even exposure, 25% each, to sugar, beans, corn, and wheat through our funds, which of course mitigate contango and backwardation. It is a fund of funds, and it has all the characteristics of fund of funds, its fee structure and its operations. But I think it's a handy tool for portfolio diversification if people tend to go that route.
Fantastic. We'll check it out. Sal, always good to have you here. Thank you very much.
Appreciate it. Thanks, Mike.
That's it for now, folks. This is Mike Norman. See you here again next time. Take care. Bye-bye.